Yeah, let's dig into that a little bit because there's a couple of things there that relate to Matt's question. So we've got a very high bar to get into a trade into the portfolio.
Exactly right, yeah.
We've got a second bar, which is an idiosyncratic bar for trade 2, 3, 4, 5, 6. And now we're putting the trade on. How do you think about the position size for those trades that you've got on? Right. And then the other thing is when that trade is in your favor. So it's great. I bought at 10. My stop was 9, but now it's 15. And even though, my trade is profitable, when I'm putting that P&L and sending that statement to those clients, they now have internalized $15 as their money.
Yeah.
So now we have the initial position size that we've got to determine and the trade management as it goes along, because that $10 price fades into the rearview mirror quickly as we're at $20, and now we're 50% away from the initial trade position. So
yep.
How does this cascade through those decisions?
Yeah. One thing that is important to say is that in the majority of conversations that we have with investors and the investing public has, most of the time is spent on how do you pick your trades, which we just discussed. Yeah. To be honest, that's the least important part of it.
Yeah. Well, you've said you have a 55% success rate.
Yeah.
Right. So you have 55% of your trades are winning. So that's not where the juice is coming from. Exactly. The juice is coming from the right tail of those trades that paid you an asymmetric payoff, and you kept them and
truncating the left tail.
Yeah. Exactly. You beat those good trades to death and truncated the losing ones.
So I went from, let's say, 50% hit ratio on a random sample to 55-45. It's a significant improvement, but it's nothing to write home about. Because in this case, and in any case, what really matters is what happens after you put the trade on. And that's one thing. And the other thing is something you, Mike, said, is how do you size your trades? Like the sizing really, really matters. And the truncating, basically not getting the losses very high, getting the losses getting too big. Now, on the sizing, when I was a discretionary trader, and when I do some of the discretionary trades on the side, we have this concept of conviction, right? And that's wrong. That's wrong because we do not know the future. And anybody that has been in the market for some time will tell you that they are surprised about what are the trades that work and the trades that don't work. And there is not that much correlation between what we think it's going to work when we put the trade and what actually happens later. And even the best investors get it wrong. It's like Bill Ackman's best ideas were Valiant and Herbalife. He really believed in them, I'm sure, but they didn't work. And that happens to him and that happens to everybody. So conviction is a very dangerous game. Sizing by conviction, as I used to do, I think it's a bad method. What I do is I size all the trades the same. I don't try to optimize. I think optimization is a very dangerous game. I'd rather be robust. And because I don't know what's going to happen, and because all of the trades that are getting to the portfolio have cleared the high bar, they're all equally good to me. So they're all...
Marcos, just to clear, are you always fully invested? It sounds like you're not.
No, I'm not. That's another thing that is wrong, but we can talk about that.
So you're equal weighting them, but it's really when you're in a trade, that trade gets a certain fixed amount of capital.
It gets let me elaborate. It gets
is it a risk weighted?
It gets a fixed amount of risk.
Okay. Yes. Okay.
Yeah. It's not a risk because not stocks and any market really have their personalities, right? So there is what is in effect is vol weighting, right? Volatile stocks get less dollars and less volatile stocks gets more dollars. But in terms of risk, I'm always risking the same amount of capital on every trade.
Energy companies get a lower allocation, utilities get a higher allocation, basically.
Well, it would depend on their. I'm assuming it would depend on their volatility at the moment that you're putting the trade on.
Yeah, it depends on a number of factors. It's not a naive volatility weighting, but ultimately what it means is that every trade gets the same risk allocation. And at this time, we're running at 75 basis points per trade. So every trade we put on, we're going to risk 75 basis points. And that is basically what we would lose if our initial stop gets hit.
Yeah.
75 basis points of standard deviation.
So 75 basis points of the capital.
Yeah.
So in the event that all of you own 20 stocks, in the event that all those stocks get stopped out tomorrow, you're in a 15% loss position. And that's kind of the way that.
Yes,
around 20%.
If we enter all of them today, and we get all stopped out, all of them today, that will be the answer. The reality is, as the trades move up and down, the risk in the trade will change, and sometimes the trade, the risk will get smaller, and sometimes it'll get bigger. And that goes to the question of Mike was saying, is that what do you do with trades that do really well?
Yeah.
The orthodox trend following will tell you nothing. It will tell you do nothing. It's a good thing that that's happening. And that's how I started. But stocks are not futures. Stocks have nasty behavior sometimes. And as you said, there is the reality of other people's money and the reality of drawdowns. And that when you get it, let's say if you start with 100 and you go to 200 and then you go back to 130, you still make 30, but some people will think that you lost 70.
Yeah. So
now I changed some things, and I do when a trade gets too big because it's doing too well, that means that I have an oversized risk in one stock. I'll bring it back in line with the rest of the portfolio.
So there's a threshold.
There's a threshold at which point basically I have too much concentration risk. And because there are stocks, and any stocks in my heuristic, any stock can fall 50% in a day. That's my kind of rule of thumb.
Mm-hmm. Mm-hmm.
And if one of my stocks fall 50% in a day, obviously I will have a very bad day. But that shouldn't kill me. Obviously it hurts. It shouldn't kill me. Now, when that number gets too big, it needs to be brought down, because any stock tomorrow can fall 50%. So if I have, let's say, for argument's sake, I start with a 5% weight and it's gone to 10 or 12, that's too big. Because if it falls 50%, I have a down 6% day on one name. That's not really acceptable. So basically, what effectively happens is that I sell some of it, take money off the table, and I bring it in line with the rest of the portfolio, so I don't have an oversized risk in any one name.